Okay. And DeFi. Yeah, so we have like getting some people online and stuff, so I'm just gonna set up for
That's trippy.
yeah.
I actually like the touch power ones.
Yeah. Okay. All right. Cool. Yeah.
All right,
Good.
we're gonna kick off. Hey gang, so hi, I'm Will. What am I supposed to say? Hi, I'm Will. I'm a normie. I don't know. It feels like an AA meeting or something. I'm the Chief Marketing and Distribution Officer at Dragon Capital. We're Vietnam's largest asset manager, very much TradFi, but willing to learn. As for me, my background and why I've been asked here today is I used to be a securitization maker, a structured finance maker. All the shit that blew us up in 2008, I'm very sorry. We did not intend any of that stuff to play out that way. But really what Anne and Leo have asked is for me to share with you how TradFi has been innovating. Where are the ways that we have farmed yield? Where are the ways that we have created different types of opportunities? How do we innovate? And really see what can inspire you on your journey as builders right now. My exposure to digital assets goes back to about 2011, maybe a little earlier, buying Bitcoin for just under $100 a Bitcoin, which I promptly used to buy weed on Silk Road 1.0. Oh yeah. Yeah, everybody remembers the pizza guy. I'm the weed guy. Yeah, my quarter ounce of Northern Lights no longer seems so fairly priced. I lost a first big batch of Bitcoins to the FBI when they shut down the Silk Road 1.0. My name is William Ross, and I'm Catholic and always paranoid and guilty. And when I saw the headline that Ross William Ulbrichts, the first Red Pirate Roberts, had been arrested, I'm like, oh fuck, it was me, I didn't realize it, you know. Anyway, I lost Bitcoins to the FBI. I lost a second batch of Bitcoins when the Red Pirate Roberts 2.0 invented the rug pull on Silk Road 2.0. I lost a bunch of ETH to a sex collapse in Hong Kong during the first crypto winter. So custody obviously is a big issue for me. Fortunately, I'm not a big investor now, but why I've connected with An and Leo and the whole Solana world is that for us at Dragon, we see the change. Daily trading volumes on equity in Vietnam, 1 billion and 1.5 billion. Daily trading in digital assets in Vietnam, 5 billion plus. In many ways, consumers have already spoken, and what we're waiting to see now is to figure out how we can leapfrog the adoption of conventional financial assets in Vietnam with their digital expression. So today, as we talk, ask any questions. This is your time, but I'd love if we could ideate together and figure out, hey, what are things we can do? So, to begin.
Sorry, I need to pick up some people. So.
Oh, sure. Do you want me to hold off?
Yeah, 1 second.
Yeah, no worries.
I need to.
Any questions so far? Want to know what it was like to buy $100 Bitcoin?
Yeah.
I remember I got really salty when it was more than $100. The fuck is this? Just nobody at the time could conceive of it as anything other than a currency. The idea that it could be a store of wealth was just like, I'm not a fool, guys. You know, it just didn't seem ever possible. I remember when it got to $1,000, it was like crazy. I told my wife about this the other day. I think we were the closest to divorce we've ever been. She's like, you did what? Wow.
So how many Bitcoins did you buy back then?
Oh God, probably a good 20.
20?
Yeah.
Crazy.
Yeah.
$2 million now.
Dude, come on, man.
No, he has the vision to buy it and hold it until now. I never met the guy.
No, I don't. Look, it's just I remember it was all peer to peer, right?
Yeah.
So I was in Hong Kong, and at that point in time, there was a company called Asia Next Gen, and everything was so on the down low that to on ramp, I would just transfer from my account at HSBC to their account at HSBC and send them a notification. That was it. Like there was no friction whatsoever.
There's no centralized exchange back then. Yeah.
There were, but they were really small. Yeah, there was nothing like Binance or anything like that. It was just, you know, three nerds in hoodies hanging out, you know, setting stuff up who now are all extremely wealthy. And there was, like when I bought some Bitcoins when I was in the States, I'm Canadian by the way, it was all peer-to-peer. I found like some dude on, it wasn't Reddit, it was some message board. And I transferred him money and he transferred me Bitcoins and that was it. It was all super, super informal. And then, yeah, you know, you go to the hidden wiki and find out what was the latest address of Silk Road 1.0 at the time. And, you know, it was like guns and drugs and I don't know, all sorts of weird shit. No, I never saw that. Come on, let's not exaggerate. This is like a movie or something. I bought, in addition to weed, my son was very naughty and he started using a laptop in school. So I bought sniffer software to stick on his laptop, which probably means his computer was being hijacked by North Korea every day, every time he logged in.
So the FBI contacted you about the Silk Road thing?
No, it was just, at that time I had Bitcoin sitting in escrow at Silk Road 1.0. One day I logged on and there was a big, this site has been seized, yeah. And then the Silk Road 2.0, like, do you guys remember this? Do you know who the Dread Pirate Roberts is? Like, the connotation of that?
I think most people don't really remember.
Oh man, okay. So
I bought because Bitcoin 2015.
Okay.
So yeah, maybe. But I think most of these guys.
So there's
there's
a movie from the 80s, which is really sweet, called The Princess Bride. You should check it out. It's a fairy tale. It's a love story. Watch it with your partner. You'll love each other, look into each other's eyes at the end. It's really sweet and touching. But there's a character in it called the Dread Pirate Roberts, who is this legendary pirate, as the name implies. And what's cool in the backstory is that there is no one Dread Pirate Roberts. It's just a title. The title is more important than the person. And when the first Dread Pirate, or an incumbent Dread Pirate Roberts is getting ready to retire, just hands on the title to the next one. And so that was kind of cool about the Silk Road 1.0, was like this person who could be anyone and then could pass on the mantle. Yeah, so it was really, it wasn't, as much as it was tech, it didn't feel techy. It felt more like a pop culture game at the time, right? Like it was full of like movie references and references to kids' movies. You know, there was nothing, it felt revolutionary in a sort of way of like, you know, passing notes in class without getting busted by your teacher. It didn't feel really wrong or shady or illegal, or at the same time, it didn't feel like, holy shit, we're gonna transform global finance. Can I kick off now, or are we still waiting for someone?
No, good.
Okay, good. But look, transforming, this is why I've got, everybody know who this bad boy is? Do any of you know him? Have you ever seen the t-shirts that like Gen Z wear? Okay, this is David Bowie. Your homework for all of you today is go home and listen to at least one Bowie album. And we'll pretend we never had this conversation in our cultural world. Bowie was a British artist from the 70s, died about 10 years ago of cancer. And he was really famous for a lot of reasons, one of which was constant reinvention. So this was one of his characters, Aladdin Sane, but he also reinvented himself as Ziggy Stardust and Halloween Jack and all this sort of stuff. But why I put it up here is he was the guy who inspired me to go into structured finance. Who's heard of securitization? Anybody heard of it? All right, okay. So securitization to the 90s is what tokenization is to today. Securitization was viewed as something that was going to transform finance, was going to take away all the risks, was going to allow us to repackage, restructure, de-risk the system. And I bought in. And it was him who inspired me to go into it. Because, and we'll explain later how he did it, but he was one of the first major artists to use securitization to essentially the equivalent of tokenize the song royalties from his back catalog. Yeah. And it was a way for him to raise money, to borrow money, to go invest in this new thing called the internet. That was called the Bowie bond. And the Bowie bond inspired me so much that it actually helped shape my career. So I spent 20 years as a structured finance banker. And what I'm going to break down for you on the next slide, and today's lesson is going to be really straightforward, is how to think about financial innovation. Okay? And we're going to do it with a super easy framework, kind of like you're picking a salad or making your own pizza, to break it down into three things: the risks you're looking at, the way you're going to generate returns, and the structures you utilize. Now, I'm going to explain this to you first starting from a TradFi perspective, and then we can tease out what that means for DeFi. But first of all, risks. What's a risk in a finance context? Anybody have an idea? How would you define a risk? Okay.
It's totally about like instability.
Yeah, it's like instability, but really what it comes down is to the instability of prices. Ultimately, a risk is something that affects the price of your asset. How can we affect prices? Well, the most basic one in all of finance is credit. I lend you money, you don't pay me back, the price of that loan drops significantly. Credit risk is the most fundamental risk. Credit risk can be that direct lending relationship. Credit can also be in a counterparty. You and I have a trade for a contract for difference, right? For example, as my value goes up, like the value of my bet goes up, the money you have to pay me also goes up, which means I have a greater credit exposure to you, right? So even in a trading relationship, if you have an open trading relationship with somebody, you have credit risk. Next is regulatory. Regulatory risk can take many forms. It can be accounting treatment, it can be capital treatment, it can be what's permissible, so interests that are, instruments that are allowed, right? Like, for example, the regulatory landscape right now under Trump is changing dramatically. What is permissible has broadened dramatically, but that could change. And regulatory risk can lead to prices. Why? Because it can affect the liquidity or the illiquidity of an instrument.
Is it more difficult for companies or institutions to prepare for regulatory risk because it's more unpredictable?
It is. It's also slower moving. Regulatory decisions happen in big blocks. And as we know, regulators maybe are well-intentioned. Let's be generous. Let's be generous.
Yeah.
But not necessarily are well-informed. What's an example we see in Vietnam right now? The requirement for paid-in capital of $400 million for a sex license. To use a technical description, it's fucking crazy. I mean, don't worry, you can drop F-bombs in front of me, it's all right, I'm not your dad, okay? I may look like a narc, but I'm not, it's all right, chill out. Right, that's like 20x what you need in Singapore. Why? Okay, maybe it helps protect the interest of banks, and often you'll find regulators protect incumbents, but from a risk standpoint, hard to justify. So you're right, regulatory risk is often one of the most expensive ones. It's the one that can most impact price. What's another example, non-finance example right now, is renewable energy. A lot of renewable energy projects in Vietnam. When I moved here 4 years ago, the country was super proud of how much of its grid, the power in its grid was being sourced by renewable energy. EVN over the past few years has basically stopped paying these companies over a contractual dispute, and the value of those assets have gone to essentially zero. That's regulatory risk, hardcore. Volatility, prices go up and down. And prices go up and down independent of their intrinsic value. And you know that. You guys know that better than I. The intrinsic value of something is not equal to its market value. Its market value is what somebody's willing to pay for it. True to my nerd form, when I was a kid, I used to collect comics, and I always used to plead to my father to lend me money to go buy comics. And I'd be like, I can sell these, they're worth so much. And he'd always tell me, only to a collector. And it's true. Illiquidity. As a grown up, I switched from comics to art. I have a lot of valuable art that I cannot sell. It's volatility in price.
Did you buy NFTs?
Hmm?
Did you buy NFTs?
No, I didn't. My son did. Yeah, my son has lots of things figured out that I apparently haven't, because, you know, the typical father-son relationship.
Can we bring him in as a mentor?
Shit, actually, I don't know, man. If he's kicking ass so much, why am I still working? Rates, foreign exchange, interest rates, right? The fundamentals. All the stuff when we talk about options and option theory, all those things that can affect prices. These are the things that actually, day to day, living your life, are the things that affect you the most. What are the problems we have in terms of rates risk in Vietnam right now? Dong dropping like a stone. Dropping like the stone against the dollar, that's dropping like a stone against foreign currencies. Not great. You want to learn a cool finance term when you have two risks working against you at the same time? That's called wrong way risk. So drop that next time in front of your banker friends and impress them and say, well, I think that's a classic wrong way risk. Anyway. Interest rates. 2 years ago when the whole Madam Land thing happened, and the state bank raised rates, and mortgages suddenly went from like 8% to 15%, god damn, that hit households, right? People were struggling. Rice in the bowl was not assured. So rate risks are the ones that not only businesses face, but individuals face acutely. And then insurance, buying protection. Finance always breaks down to two basic behaviors: saving or spending. And that's true for companies, that's true for individuals. You get salary, you get paid, what do you do with your money? You either save it or you spend it. If you extend that a little bit further and go from at a moment in time and add duration, extension, and you add risk. Can I use this?
Yeah.
You're good.
Yep.
Break it down. Look, if I'm giving you Finance 101, just tell me the stuff you already know and I'll move on. But if you could
It's gonna be one. Let me borrow the I'll be back.
Yeah. While we're paused here, any questions so far? Is it clear? I can test all of you and all the material. I can look like your teacher now then, huh?
What would you have to do in order for it to be defined as saving?
Okay.
Like, let's say you put it away, but it's not keeping up with inflation. Is that technically going to push that asset to fall into the spending category if it's losing value over time?
Good question. I mean, look, there's no absolute definitions here, but typically the rule of thumb is something that's inactive is saving. Now, what we're going to get at is the distinction I'm going to make right now.
Need a blue pen?
No, that's all right.
Let's sleep.
Okay, thanks. This rolling board is going to be a source of comedy, I can tell you that right now. Okay. 1 or 100%, right? It's all your money. So the most fundamental, everything I don't spend, everything I don't put out on food, I don't use on beer, I don't whatever, is a form of saving. Your question though is the right one, which is value. Does saving necessarily, does inert cash necessarily create value? And the answer is no. Right. And this is why we get into a next level, which is investing and borrowing. And what's added here is time plus risk. At any point in time, if I have money in my pocket, I can spend it or I can save it. It just sits there. But that's not necessarily going to generate a return for me. And as you say, if inflation is rising, keeping that money in my pocket actually is value destroying for me. How do I address that? Is where DeFi comes in, amongst other things, which is creating an additional return, which is where investing comes in. And investing always involves risk. Always. Or it involves time. Some form of illiquidity. That can be a day, that can be a week, that can be a month, that can be a year. It could be 30 years. You buy a 30-year US Treasury. But you introduce time and risk. How does spending become borrowing? Can anybody figure out the relationship there?
You spend more than what you need.
Yeah. But how do you do that?
You need to show some kind of collateral.
Yeah, you can, yeah. But basically what it comes down to is, this is where we go above 100%, right? I'm potentially I'm spending more than I earn. And how do I do that? Is I borrow. That's what borrowing is. You don't borrow just to kind of hang out and say, hey, I got money I borrowed in my pocket. That's idiotic. People do that, but it doesn't make sense. Fundamentally, you borrow money to spend it. Borrowing is a facilitating of spending behavior. You borrow money to buy crypto. You borrow money to buy a house. You borrow money to buy a car. You borrow money to pay for your kids' education. You're spending today what you haven't already saved, and you're paying that off over time, right? So we're still fundamentally only ever talking about saving and spending, but we've added an element of time and risk. So the risk here is I gotta pay it back. The risk here is I invest badly and I end up with less than I started with, which I can assure you I have done many times. Chasing equity rallies is some of the best exercise I got. What's the one last fundamental part of finance, is where this started, is the idea of insurance. What's an insurance policy?
Transfer of risk.
It's transfer of risk. How? How is it transferred?
Basically hedging your bet by paying a monthly cost to somebody else, assume that risk if shit hits the fan, for lack of a better term.
That's technical description, we can use that, yeah, okay. All right, is that saving or spending?
Ooh.
That's not that.
I want to say spending.
Okay, talk me through it.
Because it would fall on that monthly cash flow where it's, hypothetically speaking, it could carry on indefinitely without ever becoming covered.
Boom, there you go. Okay, so the answer is, it's really a bit of both.
Yeah.
Why? Because in insurance, what do I have? I have a contractual arrangement with someone who over time I'm paying a person or an entity money, premium, that's the word, for them to give me back money if something happens. If. The fact that I get money back really makes it a form of investing. But it's a type of investing where the realization is uncertain. It's an even riskier form of investing in a way. It's also, back to here, one that's replete with credit risk. In Vietnam over the past few years, there's been a lot of scandals around the mis-selling of insurance contracts because people took out insurance policies with these promises of savings. Wow, you're gonna make like 12% return per annum. I know that's nothing in crypto world, but you know, to us normies, that's a lot of money. And then what happened? People found out they didn't own anything. That money they gave each month was just paying a contract. It wasn't going and buying securities on their behalf that they owned. You never owned anything. You just owned a contractual relationship with an insurance company. That when people went to surrender those policies and say, okay, give me back my money, it's like, what money? You've just been paying us on a contract. Insurance though, and this is not just to throw shade at insurance, but insurance, the idea of what, Carl? Mark, there you go, I fucked that one up.
All right.
That's all right, I'm gonna do more. All right. What Mark just said in terms of transferring risk is the idea in insurance. And what you'll find, a lot of the things you hear about from Wall Street, like credit default swaps or significant risk transfer trades, are really just forms of insurance where it's the market rather than an insurance company that's providing the protection. But it's offloading a risk for a price that gives you a return if an event happens. So these are all different forms of risks, and all of them are things that can generate volatility to prices. Those could be prices of securities, those could be prices of physical assets, those could be prices of contracts, but it's something that generates risk. Why is that important? Because that is how you're going to get paid for finding a solution. Now, before we go into returns, these are not mutually exclusive. And that's why I've kind of put it here like a menu at a restaurant. A structure can tick multiple boxes. You can be dealing with credit risk, like our example of insurance. There's credit risk in an insurance company because they may not be able to pay you when it's time for you to get the money. Interest rates may go up, which means that you may have had a better alternative solution. So these are not independent risks, but there's a way of thinking about how each of these, everybody do calculus? Right? Everybody know their calculus?
Forgot most of it. But.
That's the benefit of any education, right? That's the privilege of an education. To say I've forgotten more than you will ever know, right? Be a full dick about it. But these are all partial derivatives of a price. All of them independently influence a price. Returns. All right. How are you going to get paid for managing risks?
So I just have one quick question.
Sure, go for it.
When you were structuring, would you guys kind of run through all of those models from a situation standpoint to help structure what you projected would be the right one, obviously with some uncertainty?
Yeah, well, we would kind of like, I've broken it down here to make it as clear as possible. But typically we would start with at least one of these as what we were looking to solution for. Were we helping a client raise money? Credit was the primary risk. Were we helping a client, especially banks, change the accountancy treatment or the capital treatment of assets on their balance sheet? It was regulatory. If we were looking at protecting clients on changes in rates, like, oh, I borrowed money in dong, but I've got to pay in US dollars. How do I make sure I don't get hit by the exchange rates? Then we would be looking at these.
Gotcha.
And then often we'd be using an insurance type wrapper as a way of solutioning that. And we'll get to examples in a little while.
Okay.
But the way you get paid, the most basic is a fee. It's no different, really. I mean, in the DeFi world, it's close to staking, right? You're just providing a service, and in setting up that solution, someone will pay you a fee. And the fees, especially in derivatives, can really be material. Really, really material. So it's not all trading returns. At times, just setting up the structure is how you generate a return. Second thing is leverage. What's leverage? Boring.
Everyone should know this.
Yeah, guys. It's boring, right? Somebody give me an example of leverage in the DeFi world?
Futures.
Yeah, futures. Looping, right? Looping. Yeah, looping is the clearest example, right? You know, it's like trading on margin. Looping is a form of trading on margin, right? I have $10, somebody's willing to loan me another 20. I borrow that, I invest 30. When I sell, I repay the 20 plus the interest I've been charged, right? That's leverage. All right. Carry. Very aligned, but different. Again, if you want to talk about, sound like sexy for your finance friends, you can talk about carry trades. What are carry trades? Well, one carry trade all of you know and know well is strategy. Treasury companies are carry trades. What is a carry trade? A carry trade is when you borrow on the shorter term and invest on a longer term, right? Strategy's investment in Bitcoins, do they have an expiration date? No, they're indefinite, right? They go on. Strategy borrows the money to make those trades happen. They issue bonds, or they issue convertibles, or preference shares that do have an expiration date. What does that mean? Let's visualize it.
So you say you borrow short to trade long?
Yeah, that's it. And what is that? It's typically an interest rate curve, slopes up and to the right. So if I borrow at, let's call it 1 year, I'm paying, let's call it 8. And if I'm investing here at 5 years, I'm I'm paying some number bigger than A. And whatever this is minus this equals profit. That's carry trade.
Okay.
Easier than it sounds, right?
Yeah, thanks.
It is. Dude, honestly, as an investment banker, I used to get paid to make this stuff sound difficult. That's how we extracted margin. That's how we got fees.
And you would just service the borrowing with other assets, is that right?
Well, you would roll over. So what does that mean? Is that at this structure, I start this at year 0. It means that, let's say this is fixed. This is fixed, this return is fixed for 5 years.
Yep.
It means that at year 1, I've got to roll this over to year 2, year 3, year 4.
Ah, okay.
And I've got risk at each of those points in time.
For their in rate.
So,
Okay.
let's take an example everybody lives and breathes here. If you borrow in Vietnam, go out and you take a loan. How long is the tenor of the loan? Anybody want to guess? Make it up, guys. There's no
10
cost.
years.
What?
10 years?
Dude, I wish.
2 years.
2 years. 2 years. 24 months, right? How do banks have that money to lend? Anybody ever really thought about that? How do banks lend you money?
Some other one saving.
Exactly. When I deposit money, I'm lending it to a bank. Fundamentally, you are, anytime you deposit, you're a lender. You lend that money to the bank, and how long are deposits in Vietnam?
5 years?
Fuck no.
No?
6 months.
I can see you're outside of like 3 months, 6
Canadian.
Oh, you think? I'm from
Yeah.
Calgary.
Yeah.
Right on.
Toronto.
Oh, cool. Typically 3 months to 6 months. So what does that mean? I've lent you money for 2 years. I borrowed it from you for 3 months. Every 3 months, I gotta go borrow it again. Which means this can move. And that's the risk in a carry trade. If you want the official term, that's called asset and liability management.
Is carry always the investment is a longer duration than or could a carry trade be the opposite?
It can be the other way.
Yeah.
But then think about what's the risk then? If I'm borrowing long and investing short, what's my risk?
Boring.
So I borrow for 5 years and I'm investing on a rolling 1 year horizon.
So we're just saying I guess.
Well, so remember, in our scenario here, my return was fixed. I knew what I was going to earn over those 5 years. It's the converse. I know how much that money cost me for 5 years, but I don't know what my return is when I go to reinvest it. So that is a form of carry trade as well, which also has the risk in it. Carry really comes down to any sort of mismatch between the term of borrowing and the term of investing. Now, depending on the rate environment or depending on the return environment, could be a good thing or could be a bad thing. The example you give is the thing my son's friends. So during COVID, one of my son's best friends, he got as much stimulus money as he could and got himself a stimulus loan and invested it all in Bitcoin. It worked out for him, but you know, his cost of funds he knew, but his return he didn't. So that mismatch is carry. So it's similar to leverage, but on a focus on a different thing. Because typically, with leverage, you're looking at things that have matched maturities. Arbitrage. What is arbitrage?
Difference in price.
Yeah, difference in price leading to what? This is real like finance 101 shit now. Arbitrage is defined as riskless profit. Arbitrage.
Do you know how market makers make money? Most of the time.
Yeah, very similar. I mean, there's a bit of risk in market making. There's risk in market making, but in general, the classic one is if I know I can buy here at a price and walk across the street and sell it there for another price, that's arbitrage. And eventually, if I do that enough, the prices should align. That's the basis of how we think markets work.
Kimchi premium, guys.
Hmm?
Kimchi premium.
Kimchi premium?
Yeah, well, so
Oh, yeah.
When a token get listed on the Korean exchange, then price go up immediately, and then that's why the market makers go
Dude,
in.
that's it. That's arbitrage.
Yeah.
That's absolute arbitrage, right? And so what you can do is you can arbitrage in the way that's arbitraging prices. Most of these risks have arbitrage as well. How do you arbitrage credit risk? I'm a Canadian. If I go borrow money in Canada, I get a pretty good interest rate. Leo's Vietnamese. If he borrows money in Vietnam, he's gonna get a better interest rate than I am. I borrow money in Canada, but I need money in Vietnam. He needs money in Canada. I borrow, he borrows, we swap.
Yep.
Now we have counterparty risk,
Yep.
but each of us has reduced our cost of funds. We've arbitraged the banking system. And fuck the banking system. Seriously. Honestly.
You can go to jail for that in China.
I know. You can.
I'll tell you a story. Oh shit, the camera's on. I shouldn't tell you this story.
I'll tell you a story when we're on camera. After camera, sorry guys, sorry, off the record, I was talking about buying weed on the Silk Road, so how much worse can it be, right? Alright, arbitrage. Optionality. What's optionality? Well, what is an option?
You get to choose.
Contract, right?
Yeah, you get to choose.
Yeah.
You have the ability, well, depending. But in principle, because it depends on what side of the option you are. But if I buy an option, I have the right to do something, but not the obligation. If I have sold an option, I have the obligation to fulfill that. Right? What is optionality about? Optionality is about uncertainty. Has anybody heard about black shoals?
Black shoals.
Black shoals? Okay, it's not some groovy type of fish. It's the classic sort of model for pricing options. But options really are about volatility. Yay, these are prices. Price, time. Does anybody know the two basic types of options? Put or a call. That's right. What's a put?
Buy.
Put
Well, it's
is
just
like
a
to
sell.
sell.
Option to sell.
What is to sell?
Call is to buy. Do you know what the price is? Do you know the term for what you call the price? Strike, yeah, there you go. Alright, so here's an example. Let's say we have an option, let's make up an option. Let's say we have a call option with a strike price of 100. And we have a put option of a strike price of 100. This is 0. Let's say this is 50. Let's say this is 100. Alright, so 100.
Strike price is like, now you gotta make up your mind.
Yeah, strike. Depending on the type of option, it's kind of like poop or get off the potty, or
Forfeit your cost.
yeah, well, it's the price you will transact at. So when the share price, like here, the price goes above 100, does my call option have any value? The price is above 100. Does my call option have value?
Yes,
Why?
because you get to buy it at 100.
And
it's
then do
worth
what?
105.
Exactly. So here my call option is, and here's the groovy term, in the money. Alright?
That's it.
What about here? Is my call option worth anything?
No.
No.
Expire.
Well, it's not expired, but it is out of the money. Yeah, this shit's a lot easier than people make it sound, right? Alright. What about my put option? When my put option, if the price is above 100, is my put option in the money or out of the money? Out. Why?
Because it's the opposite way.
Exactly, it's the opposite,
Yeah.
right? So my put option here, you know, if I can sell it for 100, but I can go sell on the market for 110, fuck am I doing, man, right? But here, damn, the price is deep. I could sell it at 100, or I can sell it at 100, but that means I can go out and buy it in the market and sell it to somebody at 100.
For the put options, who pays to buy those options? It's the buyer, right?
So this is where we get back to here and here actually. So what you have is you'll have a variety of parties. You have the person who what's called writes the option. And this is the contracting party. Like in the case of an insurance agreement, this is the insurance company. So if you've written the option, you're the person who is under that contractual obligation. You have no choice, right? And then, bizarrely, the opposite of writing is buying. And this is the choice. No choice. Choice. So, if you go on eToro, you can buy options. Right? You can buy options on NASDAQ futures. You can buy options on Apple. You can buy all sorts of options. Now, are you necessarily buying them from the person who's written them? Because options are typically tradable. Now we're starting to get something DeFi ready. Provided you can manage the credit risk embedded in an option somebody has written, that option can be traded. A token could represent option value. Right? Now we're starting to make the first hard connection with the DeFi world. What's the difference between an option and a token? Nothing. Fundamentally, it's just how the smart contract is structured around that token. And that smart contract can reflect this relationship. Everything we've talked so far can be expressed in the terms of a smart contract. In all cases, what have we talked about here? We've talked about a number that can be measured. We've talked about rules that can be quantified. We've talked about, again, numbers that can be measured. Numbers that can be measured. Rules that can be quantified. All of that can be converted into a smart contract. And so here's our first major insight. Everything we've talked about thus far by stealth, we've just been talking about things that exist or can exist in DeFi. But we've been talking about how to document them as a conventional security rather than as token. But all of them could be expressed as tokens. So we can put these two things together. And I'll show you in a second how we do it in a TradFi sense. But start thinking now that all of this, the outcome, all of this can be expressed as a token rather than a conventional security. So what's the final portion here? The structure. Yeah, go for it.
So you say that everything can be expressed in smart contract, but say something like, I think that a lot depends on the price. But price can be derived from pool to pool, right? You have value token, then how many? So and sometimes that those quantifying we cannot find anywhere.
Okay, great question. So let's decompose prices. And guys, if this is getting too nerdy or too irrelevant, shut, then we'll move on. But I think you reached a really important point. In a price, there are a few key elements. Number one is the intrinsic value. What do you think that means? So it's what something has fundamental worth of. In my example of where the asset, the stock, let's call it stock. The stock was trading at $110 and I have a call option for $100. It means I can buy it for 100 and immediately sell it for 110. I've got an intrinsic value of $10. In the case of my put option, if my put option is for $100 and the stock is trading at 110, my intrinsic value is 0. But that something is measurable. To your question, you can measure that. What's the second component of a price? Is time value. And this is not some Einstein thing. But like no physics people in the room? Nobody likes my space-time reference? Guys, I thought you were a better quality of nerd. I'm disappointed. All right, what's time value? Take a stab. Anybody want to guess? It's really just the remaining life of your optionality. So contracts have expiries, 6 months, a year. It is, what is the chance of that volatility over that remaining period bringing you back into the money? And you can model that. And look, and compared to like crypto math, it's dead easy. It's
So-
not easy, but
With the time on the contract, you have the option to execute any time throughout that time.
so you've got two types of options. You've got what are called American options and European options. So every option has an expiry date, a maturity, like a contract maturity date. With an American option, you can exercise it at any point in time. With a European option, you can only exercise it at expiry date.
Ah,
So which one do you think is more expensive if I'm going to buy an option?
the American.
Absolutely. Why? Because you're paying for more time value. Shit makes sense, huh? It holds together. I'm not just making this up as I go. And then, traded value. Here's where we get back to your question. Markets are not perfect. Markets are wickedly imperfect. Markets are not rational. Markets are wickedly irrational. The kimchi premium we talked about, right? People are often willing to pay more than the intrinsic value and the time value for an asset, or less. And so what you find is that prices can have distortions, like what you said about. The example you gave was about observability, right? So in finance terms, the ability to see a price, to say I can reference that price or I can reference that data, is its observability. What is the best source of observability? Liquid markets. How much would you pay for a share of Apple? Just go look and see what Apple's trading at, right?
Depends on how much you buy and sell.
Sure, but your starting point, do you have a starting point for any discussion around how much you buy and sell?
Market price.
Yeah, the market price, right? You can see that. All of us right now can go on our phones and within 2 clicks, maybe more than 2 clicks, within a few clicks, can know the market price of Apple. All right. What should you pay for a second-hand iPhone?
Secondary market price.
Okay. Is the secondary market price as visible as the primary market price on Apple?
No.
No, right? What should you pay for a second-hand iPhone 10? Even less visible, right?
I think that's
So-
more like a collectible.
Well, it could be, right? And it can actually be worth more to people, which is where you get into traded value. The thing is, and this is where some of the fees that you earn can be from working off of managing very liquid risks, where there's observability. But where you really make a lot of money is when you don't have observable prices, when you're creating the price, when you're finding a gap in the market, right? Where do we see this right now? Republic, or their mirror tokens. You know, their mirror tokens on SpaceX and Anthropic. Can you buy Anthropic in the secondary market? No, it's not available, right? Can you buy SpaceX? Can you go out and go on your eToro account and buy it? Cannot, right? They're not yet public. Can you get prices on what they could be worth? Yeah, you can go to Crunchbase and look at the valuations for their previous funding rounds, but you got to pay for that Crunchbase price, and that Crunchbase price could be well out of date, and is likely, especially for something that's anything involved in an AI bull story right now, is likely truly out of date. Which is where their solution of mirror tokens are so great, because it tries to create a mechanism that enables a price to be found or creates liquidity for an illiquid asset. where there's very limited observability. Are people paying the fair price? Are people paying a fair price for those tokens? Nobody knows. Nobody really knows, right? But having exposure, even if potentially mispriced on day zero, to the potential upside in SpaceX and Anthropic, that's an option worth paying, right? So again, this is where prices, and going back to your question, sometimes we don't have perfect visibility or we have perfect access to information. And that actually can be a source of incremental return if you can come up with a solution. And in the case of those mirror tokens, look, people are buying them. No, they're not getting physical exposure to Anthropic or to SpaceX. But they understand enough the mechanism to know that maybe it's 70%, maybe it's more, maybe it's 150%. But I'm still roughly moving in line with the prices of Anthropic and SpaceX as they come towards IPO, and I'm good with that. Solutions don't have to be perfect, but they have to bring you largely closer to the return profile you're trying to achieve. Is that clear? Or do you want me to dig in any further? Or have I made it more confusing?
I agree that price will go a lot with observability because we don't have the full observability of the assets.
Yeah.
And when people say that we go to blockchain and the observability is increased, I disagree. I think this is as open as TradFi.
Absolutely, absolutely. Because very few, what do we know? Look, remember, I'm a true believer here, okay, right? But what is a blockchain? Fundamentally is a timestamp of a record of registries. And a lot of all this shit is not sitting on the blockchain. It's sitting in another database that's being referenced through, I don't know, whatever, Chainlink or whatever structure you guys come up with. There's incremental data that is not observable on the blockchain that goes into any of these three components of price. Like, you know, go back, reread Satoshi's white paper. It's 9 pages long. It is the ultimate model of concision of thinking. And in that white paper, he or it or they or she solves some problems with such elegance. But the problems that are solved are just about visibility and double spend. It's not about full price transparency, right? And that's where we can't drink the Kool-Aid, right? There's what DeFi and what digital assets can deliver and deliver well. But we also shouldn't delude us that some risks or some prices are not fully visible. But that's not necessarily a bad thing. That could be a solution to be solved. It's like the question you asked me before, right, Mark? We always started with a client's problem in delivering any of these, right? We never solutioned out of thin air. Here's the mistake that companies make. I've had various avatars over the years, but there was a period of time where I was in venture capital. And what I found with technical founders, some really smart people who had developed solutions inside of a closed room that were technically elegant, very coherent, but nobody gave a fuck about, right? So solving a problem that no one, or creating a solution for a problem that no one's yet feeling. And then people would say, but Steve Jobs says the consumers, that's bullshit. It's fucking bullshit, right? You have to have some level of understanding of real world problems. I spoke earlier this year at ETH Vietnam, and there was I had a conflict with conviction, and so I was put on a different panel, and it was me with like these hardcore ETH developers. I'm sitting there, what the hell am I doing here, right? I have no domain expertise. I talk about this fluffy, hey, TradFi meets DeFi, it's exciting. But they were talking about RWA tokenization, and they're saying, what real world assets are key? And I said, look, let's spin that for a second. And not just focus on real world assets, but real world applicability. I said, go for a stroll around Saigon. Leave the palace, go for a stroll. What do you see? You'll see there's a lot of half-finished buildings. Why? Property disputes, because there's no clear title on the property. Wow, holy shit, a land registry and a blockchain, that seems like a good idea. Whoa, easy solution right there. what do you see? You see more and more private clinics, healthcare, people's data. Hey, Web3, read, write, own. If I can own my healthcare data in a way that allows me to go from clinic to clinic, to choose providers, fuck, that's real, right? And all of those are where the tech is an enabler, and you're solving solutions, you're providing solutions to things that people actually care about. Because look at your Maslow's pyramid of needs: shelter, health. You're dealing on really fundamental things and the problems that exist at scale. So I'm realizing we're running out of time here, so let me wrap things up. There's only one more slide after this, but final thing is, how do we execute this? So what is the nature of what's being created? And there's really three main forms. Cash means if I raise money to buy something, I physically buy something. Okay. Synthetic, it's a derivative. It's just a contract that references a movement in prices and may reflect any and all of these variables. And a hybrid is both, which will have a mixture, all right? Gang, you have 20 years of my finance experience distilled on a single slide, which is a little sad in terms of what I've achieved with my life. But if you keep this in mind, as you start thinking about ways of creating additional return, or different forms of solutioning, or ways of structuring a risk-return profile and embedding that into a contractual arrangement that turns into a token, especially if you're looking at finance applications, this is a framework that will help you at least think through and organize your thoughts so that you have clarity on what is generating the volatility of your risky asset, what you're solutioning, and how you're getting paid for that, and then ultimately how you're executing it. Does money need to move, or is it purely a derivative, or a combination of the two? Let's apply that. All right. Securitization. What caused the financial crisis? Anybody know? Or anybody remember? You see The Big Short?
Yeah.
Yes.
Yeah.
Synthetic assets. Synthetic assets.
Yeah. What type of synthetic assets?
CDOs.
CDOs, that's right. All right, let's get that down. So, what is a CDO? Anybody know what that is?
Credit.
Right. You want to guess? Anyone want to guess?
I buy something from you.
Oh, no.
I
What does
think
CDO stand for
A
first?
CDO.
What does it stand for?
Credit default option.
Good try. Wrong, but good try. Thank you. Who wants to play again? Anybody want to try? There's no cost, guys. You're not paying me in Bitcoin. All right. It is a collateralized.
Debt obligation.
Oh, yeah. Look at that.
Round 2, baby.
Fucking A, huh?
He's back.
Seriously. Autocomplete is on. Collateralized debt obligation. It's a portfolio of bonds. Or a portfolio of credit risks. All right. Everybody know basic accounting? Know what a balance sheet is? What it looks like? Right? Kind of, maybe, sort of.
Credits and debits.
Yeah, okay. A balance sheet is composed of two things: assets, liabilities, right? What I own, what I owe. What does a balance sheet always add up to?
Equity.
100. What do you have in a CDO? What are the assets you own? Or a bunch of bonds. And those bonds have what? They'll have a rating. They'll have a maturity.
Interest rate.
Exactly. Do you know what we call that in the finance world? Coupon. Coupon. All right. You have a portfolio of bonds that have a rating, they have a maturity, and they have a coupon. The lower the rating, the coupon is going to be what? Higher or lower? Higher. Okay. The higher the rating, coupon is lower. Risk return.
Higher the maturity. Higher the maturity. Higher the coupon.
Can be. Well, it depends on how the yield curve is shaped. Yeah, but typically, here we're back to carry trades. Typically, the longer the maturity, the higher the coupon. If you put all of this together, you have an average. You have an average rating, you have an average coupon, and you have an average maturity. Right? CDOs, typically, the average rating would be somewhere around single A, triple B,
What's the best rating?
triple A.
What's the worst rating?
F, default. Or D, default. Okay, quick on ratings. Ratings, you've got the two major agencies. You've got Moody's, S&P, and you go from AAA, and then you go like AA, and these all have plus or minus, single A, triple B, double B, no, what is it? It's triple B, BA, B, whatever. This is investment grade. Everything below this line is high yield, or the colorfully described junk bonds. And this is the same thing, double A, single A, triple B, double B, oops, single B. And then in both cases you have default. Actually, triple C. The thing that the financial crisis was famous for was the use of securitization to take a portfolio of, for example, what did they call them? Subprime loans. Ninja loans, not in job.
No credit, no income, no problem.
Yeah. If you were gonna guess, what would be the credit rating of a subprime loan?
What would be the credit rating?
Yeah, the credit rating.
That's BB minus or something like that.
Yeah, okay. Alright, so let's assume double B minus. Alright, that's the average credit rating across the portfolio. If I break that up into pieces, what do you think is the top rating I can get?
Top rated bond within.
Yeah, so if I were to break this up into pieces, and I'll explain how, but just conceptually, I'm breaking this up into different pieces. What do you think I can turn a double B minus rated portfolio into?
Double A.
Triple B?
Triple A. How? And this is why the financial crisis was such a big thing.
Say that again. You lost me there.
Well, I'm going to explain to you now.
Okay.
So, how do I turn double B minus loans into at least, and you see, you notice I put a line here. Not everything here is double A, triple A. But at least some of it is.
You're creating another asset by combining them.
I'm combining them, and then I'm breaking them up into pieces. So here I have 3 pieces, or tranches. This is tranche 1, this is tranche 2, and this is tranche 3. Why is that important? Off of all of those double B minus mortgages, each month, what happens? People pay, or they don't, right? When they pay, you have income. When they don't pay, you have losses. And so here's the first step of the magic. And actually the most important step of the magic is what's called a cash flow waterfall. Is how you take that money and you pass it out, right? It's called a hierarchy. So, when money in a securitization comes in against that portfolio of loans or bonds or credit cards or music royalties, the first thing that money does is pay the bankers. That's why I say fuck the banks, right? All these senior expenses, so this continued. But the next is here. Any payments go to the AAA. And once they've been paid their share for the month, you pay the mezzanine. And then once that's been paid, anything that's left over goes to the equity. You've taken one pool of cash flow, but because you've introduced priority, some people get paid first, some people get paid second, some people get paid third. Losses, well, how do you think they work? The opposite direction. Any losses that occur get first booked against the equity, then against the mezz, and then the senior tranche, the AAAs. Still the same cash flow. But what does it mean? I know that as the senior holder, I have greater certainty than the equity holder of getting my cash back. That's represented here. Here's the water flow. Cash comes down, returns. Now I've used cash, but that could be trading returns, that could be maturities, that could be all sorts of things, right? But you've created subordination. This, well, this is most senior, but this is senior to this, which is senior to that, and this is senior to both classes. Meanwhile, the risk, the losses, go the other way. What does that mean from a return standpoint? These are the losses that happen across a pool. Over time, they will wipe out an equity tranche first. And if that gets fully wiped out, then they'll wipe out a mezzanine tranche. And only if those two get wiped out do we start seeing losses to the senior class. If the historical losses, so let's take my example here. Let's say my historical losses are, let's make it, give me a loss number.
10%.
Okay, 10%. If these proportions are 50%, 30%, and 20%, how likely, based on a historical loss of 10%, is this going to affect and realize any losses?
No.
Really low, right? Why? Because you're talking 5x historical losses. That's how you go from double B to AAA. I know it may seem like bullshit, but it comes down to cash flow. What's a credit rating do? It tells you what's your likelihood of getting paid. And because you've created this subordination, you're able to change those cash flows into one that has a lot less risk than the underlying portfolio suggests. This is not something that has been applied in the token space yet, and it's begging to be done, to take a portfolio of risky assets and introduce different classes. Why? In my example, what's the leverage on the equity tranche? You guys figured out, I can tell you, but it's 5 times, exactly, right? I got 5x leverage here. What do I have here?
3.3.
You gotta keep this in bold. It's twice. All right. Look, there's no leverage. What you've been able to do is just by cutting things up into different pieces from cash flows, you've suddenly created leverage. You haven't had to borrow it from anyone. You haven't had to have a cost of that leverage. You've achieved it by taking additional risk. Something that is begging to be applied in the token space.
But you only do it if you have to have the different obligation to pay, right?
Yeah, you only do it by creating the different priority of payment.
But in blockchain, everything is smart contract, so it then definite. Like if I pay, then I pay everyone.
Sure. Well, no, but you can develop that. That's what I'm saying. This is where the innovation comes in, right? A smart contract could be referencing another contract. You can have 3 distinct smart contracts, which references the performance of the different classes in allocating the payment to be made. Right? Yes, these can be documented as individual tokens with individual contracts, but the logic in those contracts can reference this priority of payment.
Let me try. So actually, we do have this in blockchain.
Okay.
The AAA is always the network fee. Whenever I do a transaction in blockchain, even if it fails, I pay the transaction fee.
That's this.
So that's the AAA.
No, but that's different, because what you're doing there is you're talking about a system-wide. That's like paying the fees for being on Euroclear. It's platform fees. What I'm talking about here is take a discrete pool of assets. At the moment in blockchain, right, like all the venture funds that own different things, can they pool those together in the way that a CDO pools together bunch of bonds and create different subclasses. Again, I don't know. But this is what Anne asked me to talk to you about, is how this can be used, because we use it in TradFi, 30 years of performance to show you how these things work or different structures. Can you apply those within the DeFi space to find incremental sources of return? In our easy math here, we were looking at 5x leverage on this equity tranche. Could be much higher. Like during the financial crisis, there were structures that called SIVs, structured investment vehicles. They had 35 times leverage on an intraday basis. Yeah.
35x.
35x leverage. Dude, shit blew up for a reason. I mean, you know, that's why I say don't always drink the Kool-Aid.
So my question is like,
Yeah.
on the right hand side, it's
Yeah.
the same asset.
It's all the same asset, yeah.
You just turn the cash flow into
Different priorities.
Priorities.
Yeah. Which happens with any company, right? With any company, I pay my bondholder before I pay my loans, I pay my staff before I pay a dividend. And the returns on equity are like dividends. You're an owner of the company, you're the owner of the structure. Now, what you also get is the difference between what this portfolio yields and what these different coupons are. So, an example of credit cards. In the US, well, it's the same in Canada, right? You go off to university did you go to university? Okay, you didn't pull up Phil Degen, right? You arrive, first day, you're like, hey, I'm in my new residence, this is awesome. First thing they do is they give you a credit card application. And you sign it and they give you a credit card and hey, Mr. Visa's buying drinks all night. And all students fuck up. Why do they do that? Because the interest rate on credit card portfolios are 20, 25%. Credit cards are one of the most frequently securitized assets. And when you apply this, because the losses are typically so stable, you can get down to rates where the overall interest cost on this is like 5%, 6%. So you've got a portfolio yielding 20%. You're funding it at 5%. That means you got a 15% differential. You've arbitraged to create a 15% profit stream, which goes to equity. Even in a scenario where you're losing 10% per year, if you're getting 15%, incremental income, fuck it, you write them off and you keep running. So this is how leverage, how systemic leverage occurs, is by these sorts of structures. And you can create different classes, because you have different classes with different risk profiles, you can have different investors in those classes. I see great concern. What's the question, or is this?
It might systematic risk. I do see something like this in DeFi 2.0.
Okay.
When let's say I borrow something from him, he give me a piece of paper. I bring the piece of paper to another people.
Yeah.
And again, I bring that piece of paper to another people.
Yeah.
So there's a story that someone in Solana in 2021, they buy 2 developers, they create a volume of like 100.
That's called kiting, yeah.
Yes, things like that.
But that's why you've got to go back to, look, this is where product development, again guys, I'm not here to preach, right? I'm here to share and leave you guys to innovate. But this is where you can look at how things are broken down. Like, look, remember, I started, I'll finish up here, I'm respectful of your time, but I started off fundamentally believing in securitization was going to make everything better. I really believe that. I'm a bit of a nerd and a sad character, but that actually inspired me. And then, honestly, when the financial crisis hit, it was more than fear of job loss. It was heartbreak. It was like God was dead. My financial God died. Right? Again, maybe a little dramatic. It fucked up. We went from the sort of optimism, the sense of opportunity you guys feel now, to causing big problems. What's the lesson to be learned from that? The sort of, if there's any morality play in this conversation, is that things can go wrong. And it goes wrong when you move too far from creating utility and solving a problem and just focus on yield farming. Why? Because you're not doing anything substantial. You've created layer upon layer upon layer of risk. And maybe that's okay. Maybe on a short-term basis, willing buyer, willing seller, that makes sense. But on a systemic, going back to systemic risk, You can always find ways that things can break down, which is why where I'm excited around RWA tokenization is that perhaps we can address some of these things. Like Vietnam may in the next month get upgraded to emerging markets, right? What does that mean? That means that for some investors, Vietnam suddenly becomes an investable option. And my day job is still to sell Vietnam to the world. But if I'm a big Australian pension fund who have lots and lots and lots of money, and I want to invest in Vietnam, typically I want to invest by lending to things like infrastructure. Can you do that in Vietnam right now? No, only banks can. So can tokens provide access for Australian insurance companies to Vietnamese infrastructure? Maybe, right? Those are the sorts of problems I know how to think about. And those are the sorts of convergence points where when I look at the ability to sell or trade loans in Vietnam under the law, it's fucked. But when we look at what's permissible, even under the digital asset law, as limited as it is, and using some fairly basic derivative technology, that risk can be transferred to Australian pension funds. You know, this is where I get excited. And again, I'm an old man, you know, I focus on different things. But that's where I think the convergence points are, right? So there's an opportunity right now to use structures like this to solve real problems. Or if you're yield farming, to create a lot of leverage out of assets, not through conventional methods, by baking it into the structure itself. So look, I guess that's kind of my closing call. Because I gotta run back, I apologize. But any quick questions, or look, this isn't a one and done. You know, you can add me on Telegram. I'm really slow at responding. I have no muscle memory. You want to add me on Zalo, you'll hear from me quicker. Don't send me emails, emails are old, but just let me know, right? And if you guys want to noodle, if you want to say, hey, grab a whiteboard, this is what we're thinking about, is there anything we can learn from your experience? It'd be a pleasure to help out. Cool.
Quick question.
Yeah, man.
I asked so much.
No. This is your time. Ask as many questions as you want, but I gotta leave at 5.
Okay. One quick question. My feeling is the reason why we cannot build even in Vietnam, I mean finance, is not about the law, right? It's about how we structure the product. I get that because I feel that maybe the law is not really specific that I cannot use this or that, but I don't have a good enough structure to target into the assets.
Let me tell you, laws are always imperfect. I bought my first apartment because banking laws were imperfect. It's finding solutions. We're back to regulatory risk. Finding a solution to regulatory risk. Imperfect laws create opportunities to find solutions around them. And that's how you can get paid for solutioning, right? What do you need though? You need 2 things. You need 1, a structure that actually provides the solution, and 2, and most importantly, you need somebody to buy it. This is where I've seen founders often break down, is the go-to-market plan. Who's your target investor base? What's the value proposition to them? What's the return profile it offers them? And key, how does it fit in their portfolio? That is whether you're talking about TradFi or DeFi. When you say you should buy this, often you're asking somebody to make room by selling that. How does it make sense in somebody's portfolio? And this is often where I see founders, this is often where I see, as an investment banker, I would see people want to go to market without thinking about what is the buyer. One of the most profound changes over the course of my career is the rise of storytelling. When I started in the 90s, soft skills like presentation were really devalued. I started at JP Morgan, and we had to do it because that's how JP Morgan was. But you know, the idea, like PowerPoint in those days was like a slide with 5,000 words on it, and you know, people stood up and it was quite. But we have a human need to have information communicated to us in a way that resonates with us, right? The fact that I've made you laugh along the way today. It's not because I'm a natural comedian and I'm going to go do stand-up, but it was a way of helping to demystify, to take away some of the fear factor, to create some of the relevance, to create something in common. What do you think I told you about Silk Road, right? I'm a normie, hell yeah. But I tried to create a point of shared values between all of us as a mini community here today by sharing a story. That is what you also need in a marketing plan for a token or a security. You're creating a sense of shared values, shared opportunity, shared vision in an institutional investor or a degen sitting in a basement. There's always something, there's a point of congruence, and storytelling is finding that point of congruence. So that's what I love to do. You're the technologist, I hold you in awe and admiration. But if I can be of any help to you in thinking through that storytelling, that go-to-market plan, that investor segmentation, I'd love to. All right, gang, I gotta head off. What's up?
What do you guys want to hear from him for just for storytelling?
Definitely.
Yeah, okay.
We'll do an online session maybe next week or something like that. I'll talk to you.
Next week I'm in Singapore.
We got that.
Yeah, we
So
got
I
that.
think week 3 we have a session about advanced storytelling. So you hear from how he built this. Like 5 slides, 2 hours. Can you do that? No, right? So we learn from it.
All right. Thanks,
All right.
gang.
Thank you, everyone.
Can we get a photograph?
Yeah.
Oh, let me grab the guy. Alright, we have our media guy on standby, which is good.
I'm not gonna pimp you on LinkedIn, don't worry.